Hello, everyone. We just are waiting a little bit longer for more participants to join the meeting. It always takes a few minutes for the people to enter into the virtual room. So please bear with us for another few seconds. Thank you. All right, let's get started. Good afternoon, good morning to some of you, and welcome to World of Open Account, and welcome to this first 2022 web meeting of World of Open Account. We are very pleased to do our New Year's event in a virtual way, even if we would have preferred to do it, of course, again, physically. But who knows, maybe the 2023 session, there are good chances, I think, that we can do that again live in London next year, but we'll see for that. So very happy to be with you today, and I'm going to hand over very rapidly also to John and the panel. Just from my side, a big hello and Happy New Year, of course. And just to mention that World of Open Account is doing good. We are growing. We have quite some plans. We will do this year now innovation briefings. In a few months from now, we will have in February, May, June, October and December 1 hour sessions for premium members, especially around a number of themes such as ESG, such as platformication or embedded finance, alternative finance, risk, fraud, cross-border supply chain. So a number of themes and topical innovation briefings, but you will find more information on the website. And then, of course, don't forget to pencil into your agenda the 19th and the 20th of September, which will be our third or our fourth annual meeting that will take place in Germany, most probably in Mainz. You will hear more about that in the very near future. We have the support from our German founding members. So that's it for me. I'm going to hand over to John, and I wish you all a very nice and interesting web meeting. Thank you.
Thanks, Eric. And a very warm welcome to everybody joining that in. As Eric says, I think this is a great opening session for the year. I think that we're going to have a very thought-provoking hour, and we're going to be considering some of the real questions that are facing the open account finance world, and the where do we go from here type questions. So things like, how do we improve the way we interact with our customers, and how do we make doing business easy? Things like, how can we better use and interpret data when we to inform our decision making? What are the opportunities to use that data and information to target our products and solutions more effectively? What will be the role of the traditional bricks and mortar banks compared to the alternative lenders that are coming to the fore? And how will things like ESG influence the receivables finance industry? There are lots of really big questions, and of course we're not going to be able to get to the answers of all of those today, but really just to set some thought starters running and invite you to join our sessions later in the year where we'll look at these questions in much greater detail. But I think it's very important that we actually start the year and set the scene. So I'm delighted to be joined by a really eminent panel today and be able to get their input on some of these big questions that we're facing as an industry. So a very warm welcome to Kevin Day, the CEO of HBD. Kevin, obviously the head of one of the leading technology companies in the industry, really able to help us look at the technology side, to look at the strategy side of where the industry is going. Delighted also to welcome, thank you, Matt Davis, director from UK Finance, the commercial finance team there. And Matthew, really hot on everything to do with regulation and the development of the role of receivables finance in the greater picture of the finance equation for business as we come forward, hopefully out of this period of recession caused by COVID. Simon Featherstone, who joins us. Simon involved in many aspects of business, huge experience as chairman, non-executive director, advisor, both with traditional businesses and many modern businesses to fintechs and niche providers. An excellent opportunity to share views and thoughts on the development of the industry as it looks for new ways of meeting customer needs. And last and not least, delighted to welcome Stephen van der Hoofd, who's the CEO of Capital Chains. And Stephen very much specializing in looking at supply chains and supply chain finance, the role that they have, the importance of how those are developing and evolving, and the role of finance in making these more secure, more reliable through time. So a really strong team here, and delighted that you can join us. So thank you very much. Just to start with, and again, by way of a bit of scene setting, Kevin, HBD has recently undertaken some quite serious research amongst a broad base of users in terms of trying to find out what their perceptions and beliefs are at this juncture, at this time. So it'd be really great if you could just share with us perhaps just a few thoughts about the conclusions that your research has come to. And I think that'd be a very good way of starting the conversation. So if I could hand over to you.
Yeah, no, thanks, John. Well, I mean, the reason we did the research was really to get what we call the voice of the markets. We employed an external research company, a company called GrowCap, with a chap called Peter Hunt, and also actually somebody well known to most of the sales finance world, Jeff Longhurst, was involved. So actually we had some good people actually working on this. And basically they went out and they talked to 20 different leaders in the receivables finance sector, predominantly UK, but they were looking at having open questions and really kind of trying to work out where the mindset was and where, how the industry really is a sort of I guess has some downturn within the during the pandemic, but also then what's happening going forward. The research was bank, non-bank people, and so quite several hours of interviewing. Just to give you some key findings, demand grows, recovery continues. It's probably not unexpected, but as the government schemes are retracting, 2022 looks like a really good year for receivables finance. That's the word on the street. The end of support schemes, deferred liabilities, increase in mergers and acquisitions are all kind of stimulating the market. There's opportunities arise as there's market shifts. So there's a feeling, again, this is not our thoughts, this is what's come from this research, of banks pulling back from invoice finance, in particular full service factoring. Generally that site is being cost to serve reasons, risk, bad debts, fraud, opportunities, but there's an opportunity there for independents perhaps to fill a gap in that market. There's a feeling that perhaps banks feel the market less attractive. Again, that's just coming from the research. There's also this feeling of unrealized value as problems persist. And generally, this is probably not new to many of you, but around sort of complexity, the need to simplify, streamline systems, reduction in friction. And by comparison, customers out there can get other financial products with a few clicks. Onboarding and improved customer experience. Data extraction is seen as potentially a goldmine to drive smarter risk management and meaningful services. And technologies such as cloud, API-based systems, and microservice-led technology was kind of coming through in that research. And then context. So context in terms of the different solutions and how that's emerging. And again, one of the things we've probably not heard for the first time, but customers want cash, not invoice finance, was a message. The depth and complexity of the product itself, invoice finance, shouldn't create a negative experience for the customers. So how can we hide that complexity? Drop-off rates for receivables finance is high. There's a lot of admiration for fintechs, an ability to use sort of design thinking to solve customer pain points. Potential for fintechs to fragment the market, but that could also be a solution. They also be part of the solution for helping providers simplify their solutions. So conclusions, Really, it's about charting a better future for the whole industry going forward. And I would say this, wouldn't I? But providers need to invest in technology to create engaging experiences for customers, reducing cost and effort for providers, allowing them to develop new profitable solutions and services. But technology choices need to solve problems of today, but also be ready for the challenges of tomorrow. So that's just really, it's a 14-page report. It's freely available. It's on the World of Open Accounts websites, or on our website indeed. So I do recommend people to take it. It's for all independents, and hopefully you'll find it valuable. Back to you, John.
Excellent, thank you, Kevin. And indeed, I think one of the key messages that actually reading the report, it comes to the end, and I quote from it. I mean, it says the short-term outlook is strong and there are clear opportunities ahead, but the technological infrastructure underpinning the industry requires significant modernization. So, I mean, I think that's a really strong message which is coming from the user base, which I think helps inform. So what we'll do now is we'll, I think, try and address some of those questions I referred to at the beginning. And of course, I'll just remind the audience that, you know, we really appreciate you taking part. And if you have questions, use the Q&A button, and we'll do our very best to address the questions as they arise, if they're a part of the conversation. But if not, we'll address them when the time is right. So everybody encouraged actively to involve. This is a discussion, not a lecture. So very much involved. So let's move to some of those questions. And I think one of the key things that we heard that was improving customer interaction, how to make doing business easy. I mean, one of the things that we say in our industry is that typically we're looking to support SMEs, but SMEs can, you know, range from having 1 to 250 employees and turnovers from nothing to 50 million pounds or euros. So there's no one size fits all, I guess, on that. And we have to perhaps think about what are the different needs and the breakpoints, and how do we think about differentiating those. So I thought it would be good, Matt, if you wouldn't mind just having a chew on that question a little bit, because of course with UK Finance, you're dealing with quite a range of size of businesses and trying to meet the needs of quite a lot of different people.
Yeah, no, absolutely, John. Thank you. And thank you, Eric and John, for inviting us along today. Look, I mean, better customer interaction is, I guess it's a challenge we're all trying to crack in one form or the other. And believe me, that includes loads of us in membership organisations and trade associations as well. And I think anybody who's glanced at the UK Finance website will realise, you know, it's a work in progress. Just by means of brief introduction for those that may not be familiar with us, UK Finance was created in 2017 through a big bang merger of 6 UK FS trade associations. The British Bankers Association, absolutely massive. Payments UK, absolutely massive. UK Cards Association, absolutely massive. Council of Mortgage Lenders, absolutely massive. Financial Fraud Action, absolutely massive. And finally, my organisation, the Asset Based Finance Association, not quite as big as some of the other ones. So it's a pretty diverse membership that we have. We've got around 300 member organisations, and we've got the investment banks and the capital market players at one end through to the payment services providers, the UK consumer and commercial banks through to the specialist invoice finance and mortgage providers as well. So, I mean, as I say, that's a pretty diverse waterfront to represent and interact with. And the challenges that we have in doing that as a trade association are actually pretty similar to the challenges our members and the open account world generally have. So what's it about at the end of the day? It's about understanding what your clients and your members ultimately want, and as John says, appreciating that they're all different and may wish to interact in different ways and have different kind of abilities to interact with you. I guess it boils down to finding the right balance between systems and processes on the one hand, and also relationships and expertise on the other. And obviously, this is an industry that prides itself on the relationships and expertise it brings. So there's a real balance there, and how to deliver the products and services how your members want it. So, I mean, it's simple, really. We just have to do that. We just have to do that better, though. So, not a problem at all. It's good to crack the question straight away at the start. I mean, looking at the receivables finance world as a sort of a humble lobbyist who's been doing it for a while, but not an industry practitioner. As far as I can see, we're already seeing pretty big strides in the use of technology. There's quicker and more efficient sign-up processes through eDocs and AML tools and things like that. And again, you can't overstate the creative destruction that something like the pandemic causes in terms of forcing people to move on to the next stage. I guess we're also seeing easier and less intrusive day-to-day admin requirements for clients through, as I think John or Eric mentioned, greater use of account extraction tools, that kind of thing. And we're also seeing the ability to do more arm's length due diligence and intelligence gathering and risk monitoring. And it goes without saying that there's a lot more that we can do in these areas. But for me, the industry has come from a place based on developing relationships and understanding of client businesses. And to be fair, that approach has served the industry very well by, let's be frank, allowing members to support clients in circumstances when other finance products perhaps aren't going to be available or won't be able to unlock sufficient funding. And in sort of macro prudential terms, it's also served the industry well in terms of its ability to deploy and recycle capital effectively over the long term and all the way across the economic cycle. I mean, is it ever going to be the cheapest form of funding? Well, it's going to depend on the circumstances, but I hope it's not controversial to say, generally, it's probably not going to be the cheapest form of finance. Is it ever going to be completely feather touch from the perspective of the client? Realistically, probably not, and arguably, nor should it be. I mean, we are talking about business clients, we're not talking about consumers, and they're accessing not inconsiderable amounts of money, and there are, of course, responsibilities that come with that. And I do think that focusing on kind of pursuing price and light touch exclusively through technology where it comes at the expense of the industry's traditional strengths is a hiding to nothing. Invoice finance, asset-based lending, it's never going to be the lowest common denominator in those respects. And I can only speak from the UK perspective, but in the UK, immediate history, demonstrates that if the objective over everything else is to get as much funding out the door as possible to as many businesses as possible to provide what is effectively an economic stimulus, even if it isn't called that, then IF and ABL are probably not going to be the right tools for that. The industry strengths do lie elsewhere, and I do think we should recognise that and be proud of that and maximise them. So you actually put a question at the start there, John. I better come back and at least pretend to answer it. In terms of what the industry can do to improve customer interaction, it's lots of stuff we already know. It's more consistent terminology. Let's not try to confuse the clients. It's simpler funding calculations. It's streamlined fees, and also looking at the way we structure our legal documents to make them less complex and make the products and services more accessible. Those would all be a good place to start. But I guess what I'm saying is, technology has done a lot to make the products more accessible and potentially cheaper, but it shouldn't be at the expense of the inherent strengths that the industry has.
Okay, fine. Thank you, Matt. In terms of that sort of interaction sense, I think the same thing applies a little bit in terms of the supply chain finance solutions. Very much, there's been a sense that perhaps that these have been rather remoter, that they've been more the line of the large corporate, and yet in terms of how that interaction takes place, clearly there are a lot of businesses going to be involved in terms of how they get absorbed into the system, dealt with within the systems. Stephen, from your perspective, do you think there's a need for improving interaction within the typical supply chain finance solutions? I need to mute.
Sorry, if you look at the typical supply chain finance structures, right, and you look at what the market recognizes as those typical structures, it's mostly centered around payables finance or reverse factoring. And then if you would ask anyone in the market, who is it for? They'll say large corporates and their largest suppliers. That no longer holds true for all of the programs, but obviously that's where it started. It was easy to serve. And if you had one client on board it, you would have large volume and hence a stable fee income as the provider of such services. Over the last few years, however, we've seen quite an uptake in let's say, technology-driven solutions aiming to include more of that tail spend or the middle part of the supplier base, meaning that more parties will have access to it. Largely driven by, let's say, or facilitated by the technology that is let's say, active in this space. At the same time, though, that is the space where the need for financing is most imminent. It's also the part of the supply chain that is hit the hardest when shocks occur, like the COVID pandemic. I mean, they have the weakest balance sheet. They've got the lowest or the fewest options to get access to external funding. So offering supply chain finance along that value chain, specifically focused to these smaller entities, is going to be crucial going forward. And I think many parties have recognized that. I'm not saying they all have a solution for it, given the requirements that there are there for know your customer or let's say all of these procedures. At the same time, the moment you start to become active in that supply chain and you truly appreciate the strength of that supply chain and all of its individual actors, and you can act upon data and you can use that data in combination or in conjunction with your technology and your financial underwriting skills, all of a sudden you have a ton of opportunities in your hand to provide capital that is extremely needed, even though the market is flush with liquidity. But to get it to a point where people can actually use it as well. And I think that's going to be our critical roadmap, so to say, for 2023 and onwards, is making sure that we have better ways into these supply chains without increasing the risks or just passing out money and saying, guys, here it's for free, take it, and we'll hope that it comes back one day.
Okay, yeah, that's very interesting. And I think very much thinking about that issue of you say of focus and targeting. I think that's one of the key questions, I think, and it comes back a little bit, Kevin, to what you were saying earlier on about people looking for cash. I think in terms of the opportunities for better targeted solutions, you know, we talk about historically things like factoring, supply chain finance, single invoice finance. That's not necessarily what people are actually looking for. Where are the opportunities for value-added services? What's going on out there? Kevin, from your perspective, and again, maybe informed by your research, what's moving in this direction?
I think there's been a lot of, you know, to go back to the whole question about the one size fits all, I think we're probably moving away from that. I think you've got at one end of the spectrum, you've got almost like consumers. At the other end of the spectrum, obviously you've got large corporates. There's a big difference between those two extremes. I think what we are seeing is the fact that actually with the sort of the rise of the fintechs coming in and actually sort of disrupting, maybe not getting necessarily scale, but disrupting. And I think actually allowing people to rethink, you know, what are we trying to do here in terms of actually providing financing into these businesses. And I think that gives us an opportunity going forward, I think, to actually look at how we can sort of reimagine some of these constructs that we're offering to the market. And I think the whole big key part of that is about simplification. But I think that has to be backed up by good use of data that you can trust, that you can augment, that you can apply to actually make the data talk. But again, going back to what Matt was saying, you know, are we a high-tech, no-touch sector, or are we a high-tech, but there is some touch and there is some interaction with those businesses going forward? It can't just be a case where here's the money and walk away. Because obviously, I guess on one hand, you want to get your money back.
Mm-hmm. Yeah, okay. That's a clear thing. I think in all ways, in all these discussions, it's always got to be that recognition that it's very easy to give it out, but actually getting it back is not always going to be quite so simple. Simon,
as we will see over the next few months, I suspect, John.
I suspect we shall. Yes, I think there's already being softened up for quite significant losses to be expected in the case of the UK government support packages. Simon, I mean, I pass this one on to you. Really, this targeting thing, this idea of depth versus breadth and specialism, generalism. You know, where do you see things moving in this direction?
I see it being a lot more specialist or targeted or segmented, building on what Kevin was saying. Back in my day in Barclays and Lloyds, we used to want to serve all of the segments from large corporates down to startups in a lot of cases. The reality is one operating model size doesn't fit all. And I don't think enough businesses have worked out which segment they want to serve, which customers, and therefore what is the proposition, what does that particular SME or large corporate segment, if you're in that space, want, and therefore how should I organise my proposition, my servicing and my cost base ultimately to be able to do that. The costs in the industry in terms of operating costs, whether it be experienced relationship managers or salespeople, have probably quadrupled from my earlier days. And you know, if you don't fundamentally address your cost base at the front end or kind of operationally in risk, then it's very, very difficult to be competitive in any business, never mind factoring or invoice finance or supply chain, whichever one kind you're at. So for me, there will be an increasing diversification of segments that different players look to serve. And you know, do you need to invest in an automated anti-money laundering KYC for doing large corporates? Probably not, because the cost or the returns on the facility justify it. But if you want to do an increasing a volume of smaller SMEs with the shift into the gig economy, parcel delivery services that we've all seen, particularly post or through the pandemic, then you can't possibly afford to onboard those things manually, and certainly not service them either. So I think the industry needs to, and players need to be really, really clear what segment they want to serve, what their proposition is for that, then what technology supports it, and does that work economically for them? I just don't think enough people are working those sort of things through.
Maybe to add on to Simon's point, I think that also makes companies need to think about their own go-to-market strategy, right? It's not only which segments are we going to serve, but also which segments are we not going to serve.
Yes.
And I think making that decision in terms of these clients, yes, they look very promising if we could land them in a zillion years, but we're going to lose our focus on the other segments in the meantime. Making that decision in terms of we will only serve these clients, and more importantly, we will not service the others, is probably going to help them define their own market share, their unique selling points, and hence have a way better uptake later on in that journey. Because I think choice is difficult, but it's going to be critical if you want to be on top in this market. Yeah,
I mean, you take two of the UK's largest clearers in Barclays and Lloyds, both not serving, having sold their small business factoring portfolios. Really, Santander, in my view, not really playing in that space either, and NatWest possibly with their very small thing at Rapid Cash, but not. You know, all of those large banks are a pale shadow of the factoring, invoice finance, ABL powerhouses they were 10 years ago, and whether if you're an independent trying to compete, it's very, very difficult to try and compete in all three segments, large, mid and small, and then even micro at the other end. With my sort of clear factor hat, then the whole embedded automated process, despite the amount of cynicism that exists around, can you really automate operations and risk in invoice finance? People are going to have to take different risks to serve the different segments that they're in, to compete, given, Stephen said, there's just a huge amount of liquidity still out there. To get a business of any scale to acquire customer, I mean, I remember in my Bibby days, so we're doing very, very well in the traditional SME space. So how do we grow? We'll do bigger deals. That isn't necessarily always the answer. Other players that have moved down into the space, rather than concentrating, how do I get more in the space I'm already in, bring more into the marketplace by changing my proposition, rather than just moving into another space that there's lots more competition in. We still have a relatively small number of SMEs, mid corporates, and even smaller number of corporates who use our services. So there is a big market to go for, but I'm just not sure people are really clear on how they're going to do that, or and what technology supports that proposition.
Yeah, I mean, that's what's on my mind. It feels like there's a lot of money coming into the sector, a lot of money out there looking for a home, as Simon and Stephen have said. But I mean, do we think, is that money coming in on an informed basis, of people coming in with their eyes wide open?
I was going to say about risk there. I mean, when I got involved with the industry many years ago, a lot of it was about spread of risk. And when you look at things like certainly the smaller end of the market, obviously, if you have got a good spread, that's obviously does mitigate some of the risk that you might be taking in terms of actually trying to have a more of a low touch approach. But then when I look at things like single invoice finance, I just wonder there whether, obviously when you have a whole turnover, you've got spread on the ledger. You take a single invoice, you are obviously a little bit narrowing in terms of actually how you're going to actually get money back on that funding. Just wonder about how people feel about that going forward, and is that a market pressure, or is that being sold into the market as being that's what they want?
I mean, we constantly tussle with these questions at UK Finance. We want to be inclusive. We don't want to stifle innovation. It certainly shouldn't be a club for the traditional players per se, but actually being a member needs to mean something. But again, it's not for us to sit in judgment on people's business models. But if something bad happens, as we've seen over the last year or so with the elephant in the room, the entire industry can get tarnished if there's a problem with a particular lender's business model. So yeah, sadly I don't have any of the answers, but it's a live issue that we're tussling with all the time at UK Finance in terms of defining the industry. I think not seeking to sit in judgment.
Yeah, I think some of it, Kevin, and it plays to both ends of the spectrum, whether it's the small end or at the larger. If you take supply chain in that context, it's the segment, it's the sector you're focusing on. Again, going back to your value proposition. So transportation finance as a single invoice product in the US is huge business, huge. And it works because you have a spread of truckers, hauliers, whatever you want to call them, in US language. But essentially, and you have a big market for those as well. But the factoring industry in the US has done extremely well in serving a specific single invoice, but sector-led approach with specific risks and understanding those risks. And I think the same will happen with other industries. I think recruitment, which traditionally has been a very big industry for the UK, is undergoing a bit of a digital revolution itself as well. In terms of the gig economy workers looking for roles, and businesses increasingly not wanting to sign up for somebody until they really need them at literally the last hour type thing. And you can do that with some of the new digital tools that I've come across again with my Clear Factor Hub, where people are reinventing the approach to the segment, and the segment has a specialist need that our industry can serve, but you do have to take a different approach. And I think supply chain will be the same, but it'll come probably a little bit more bottom up.
Yeah, for me, I'm not sure. Is it overly simplistic? Hearing this discussion, wondering what the role of traditional banks versus the alternative and new lenders is that, it is going to align pretty much by scale. That the big banks will tend to focus on the large corporates and mid corporates, and the NBFI alternative lenders, fintechs will be primarily focusing towards the small users and the micro users. And is it that simplistic?
I'm not sure it is quite that simplistic, John, but it's certainly looking as though it's aligning that way. But I think I'll try and bring alive one example specifically, but this is my Oxbury Bank, which is sort of a reverse invoice supply chain, and bringing into some of the environmental, social kind of challenges supply chain. So in the UK, major supermarkets are demanding that the amount of methane output from the production of beef is reduced substantially. And so they are building specific, not supply chain finance that falls out of it, but demanding that the growers, producers of beef find ways of getting beef to the supermarket shelves quicker. And in simple terms, if you take a third of the days out of rearing, the time taken to slaughter to the shelf and so forth, you save a third worth of methane output in really crude, simplistic terms. And I think that kind of reinvention will take place across different supply chains, producing different invoice finance opportunities. In that scenario, it's relatively concentrated because of the nature of the underlying supermarket or supermarkets. But it's a good example of how broader social challenges are impacting on supply chains, and will mean invoice finance supply chain providers have got to adapt to be able to deal with those challenges.
And I think also, if it's so simplistic, I don't think that's true. I think there's always going to be one major advantage for banks that they have, and will always have, is they've got the client relationships, and we seem to forget that sometimes. So a couple of years ago, if you looked at the industry news, you would see fintechs coming to change the market, and they did change the market, but not necessarily the way that they thought they would. They thought they were going to replace all of the banks. And they didn't manage that because they didn't have that initial client relationship that the banks have. So I think to a larger degree as well, we're going to see specialist solutions for specialist or niche markets, like the one Simon was just mentioning, rising up from individual challenges in a specific supply chain where you could use technology. And then ultimately, you need the funding to come from either the bank or a non-bank lender. But I think that's the road.
Let me add to that, Steve. You're right. And interestingly, in that context of that particular household name supermarket, I can't say which one, but they approached their UK large clearer, who just couldn't get their head around how they could understand the technology. So, all cattle in the UK have a little identity marker in their ear, but in addition to that, they will have electronic tags that will track their movement at times of day and so on, so you can see exactly where they are at what time and when, so that you can prove empirically the time it's taken them from, in simple terms, birth to shelf. And that's a very crude expression. However, that's the reality of the demand that's coming for the reduction in carbon, that has a significant impact on the supply chain. But to be able to finance that, to prove it, because the supermarket demands that as the ultimate debtor and the underwriter of that program, you've got to be able to read that tech, including the RFID tags and the other one, and the movement ones as well, so that you as the provider, your ability to deal with different data sources, cope with it, analyze it, store it, actually was probably the first challenge we came up on that one, as an audit trail. We all understand the requirement for audit trail on proof of debt, then you know, that's not a piece of paper that's been digitized. That's a very different kind of piece of information that most providers, I guess, in the industry wouldn't have normally come across. So again, that evolution of technology from outside, you know, what we normally think about as supply or factoring providers, is changing significantly as well.
Just to add on that point, because I think it seems to me, because it came out of the report as well, actually, about the fact that as you said, Stephen, that fintechs were sort of going to be the game changer and disintermediate the banks from the whole lending process. But maybe what we see more and more evolving, we have seen obviously banks collaborating with fintechs to actually perhaps deal with some segments of the market that they didn't want to deal with directly. And maybe that's the way things will go forward, and maybe that's where technology can actually come into play, because yes, you can get sort of specialist technology solutions that are utilizing the data and the sort of the underlying technologies that are supporting a particular supply chain. But on the other hand, though, with the sort of open API world, everything being accessible and very data driven, then there's a sort of there's an interoperability layer, I suppose, that's going to bring traditional lenders in, so that they don't necessarily need to understand it. They need to almost, it becomes effectively a kind of an asset that they can actually lend against safely, securely, and within regulatory parameters.
I mean, just to put it out there, I mean, the banks are still trusted, very much trusted, despite the, you know, some of the messes of the last 20 years. Trust in banks has probably has been higher in the past, but you know, it is still, they are still trusted by consumers in a way that, you know, lots of other businesses would really envy. And I think, you know, the banks had a good pandemic. I think they've come out of the pandemic with their reputations enhanced, you know, recognizing that things can change very quickly. But yeah, that the strength in those brands is, and as colleagues have already mentioned, the fact that, you know, those client relationships they have, you know, they're not going anywhere soon. Even, you know, if the invoice finance books go elsewhere, you know, there are going to be alternative models, and the banks are always going to play some sort of role in their gatekeeping at the very least, I would have thought.
Yeah, but the volume of relationships that they genuinely hold, as opposed to where they hold a major current account, Matt, given the focus on pushing smaller businesses ever, or more larger, smaller businesses ever into the call centres, means the real relationship is deteriorating across the vast majority by volume of SMEs significantly, which is, I think, opportunity for alternatives, independents, etc. as well. But whether it's, as Kevin says, through collaboration and other kind of routes in, but I see no reversal of any banks, particularly large banks. That's different if you get into what the UK would call challenger banks, and
sure,
different at the Sparkassens in Germany and things like that. But I see no reversal of an investment in relationships across a number of sectors, manufacturing, agriculture, you name it, or all significantly reduced expertise in the larger banks, especially.
Okay, I'm conscious that time is whizzing by us, as always happens in these conversations. It always goes very quickly. Just before we turn to the questions that come in from the audience, I'd just like to see a very fascinating Simon's point about the sort of the reality of ESG arguments starting to impact upon, you know, operational methodologies, technological requirements from an investor and an operational perspective. Whether or not any of the others of you have so far found some practical examples of this, or where you expect that ESG is really going to start affecting the industry over the coming months.
By the way, did you just notice my lights went out then? That was our E in the ESG, their environment.
Yeah.
Meaning that I didn't move, so the lights went out.
Yeah.
Metaphor.
So that's the HBD contribution to the carbon footprint.
Seriously, well, we are talking about, obviously, as a technology provider, especially as we more and more we host lenders these days, and on sort of cloud basis, that actually now you can actually measure that, so you can actually give a sort of tangible sort of environmental cost, at least, to actually the infrastructure, the team that's actually effectively supporting their operation. So it's a small thing, thing.
Okay.
Yeah, I mean, it's gonna be massive. There's a real opportunity for the sector there. I mean, there's going to be new types of assets coming through and new income streams attached to them. So, you know, there are real opportunities there. And you know, if it isn't driven by the customers, it's going to be driven by the regulators as well, and the increasing requirements that businesses have to, you know, include ESG requirements in their reporting. It's probably important to emphasize that when we talk about ESG in normal circumstances, we're all talking about the E, aren't we, rather than the S and the G so far, because I suppose it's in, you know, the challenge is, you know, objective measures of, you know, what is green and what is less green. And I think, you know, particularly in the UK, we're probably further ahead on that in terms of the environmental stuff than the social and the corporate governance impacts. But yeah, as I say, it will be driven by the customers if not driven by the regulators.
I accept the point that for many it's still much focus on the E, but I suspect also in supply chains there's a much greater focus now on S and G. You know, particularly with, you know, for example, you know, the concerns about sweatshops, the concerns about the sourcing of raw materials, the conditions in the factories where stuff are put together before it's sent, and ensuring that there is a proper trail of appropriate treatment of animals, of people, of products, right through the chain. So I guess, Stephen, that's probably something which will incorporate into people's minds when managing supply chains in the future.
Yes, and I think the interesting thing here is that also means that the entire view on who do you finance and what do you finance within that supply chain needs to change. If you want to use finance as an incentive to up your game in the ESG space, whether that's on the EDS or the G, right? Ultimately, especially when it's the E, you need to start all the way at the beginning of that supply chain. You have to go back upstream and say, where did we grow this produce? Where did it come from? Where did we delve it? How did we do that? Which means that you're no longer just looking at the large entity, the large corporate at the end of that supply chain who may demand it, but you need to drive it all the way back to these various nodes within that supply chain, in the agriculture chain, for instance, all the way back to the farmers. Which poses completely new challenges to a funder, because you may fund, or you may want to fund, the seeds or the fertilizer or the pesticides for a farmer. But if you give them the money, then what are they going to use it for? Not because they're bad business people, but they may have immediate needs to take care of the family, right? So all of a sudden you're in this space where if you want to do that supply chain finance part on a whole different level with ESG or sustainability, you need to come out with, how do we make sure that we've got the data points? How do we make sure that the money that goes into that supply chain is used at the right point in time for the right purchases? So you're almost, and I'm stealing away the word, but tokenizing that supply chain, so that, you know, this money is now going to be used by this farm to buy the right pesticides from a green or a better quality input provider. Thereby the produce will be greener, or let's say more sustainable, and hence throughout that supply chain we can now tag it and make sure that the end user will get a product that is actually better than it was before. So sustainability is a big driver and will become an even bigger driver in supply chain finance, but there will be challenges that come with it that these providers of sustainable supply chain finance solutions need to cater for, and that is data and use of funds.
Good, okay, thank you.
I think also, I agree, Stephen, also being clear what you're measuring as well, because you know, you can argue red is blue on some of the ESG measures, and again, having a really clear view of gross output, shall we say in simple terms of carbon, down to where's the net change in some of this stuff as well, is a real challenge, particularly in different industries. Transport being another good one. Simple things like backloads and all the things that people would be aware of make a big difference. So yeah, there's a lot of data thinking to going on, which is something Kevin started with, how you measure this stuff.
Yeah, and from UK Finance perspective, one of our big calls on ESG is the implementation of a UK taxonomy, which will be effectively a common framework which sets the bar for investments or finance or whatever that can be defined as environmentally sustainable. Because at the moment there's nothing objective out there, and it's easy to engender cynicism, greenwashing and things like that.
Yeah. What are the early thoughts on that, Matthew, from UK Finance?
It's the centerpiece of our work on ESG, and we are hopeful that there'll be some movement on it this year.
Is that with international sort of collaboration as well? So it's not just one country has its own thing, but it's actually more of a global approach.
Yeah, definitely. There's coordinated kind of movement, Bankers for Net Zero, that coalesced around the Glasgow COP, and absolutely, it makes no sense for one country to do its own thing. Obviously, Brexit doesn't necessarily help from our perspective, but
you don't want to mention it here.
No, I already have, sadly.
Yeah.
Well, we'll look forward next time you're on, Matt, for you to be wearing your Bankers for Net Zero T-shirt, I think.
Indeed, yeah. Baseball caps, John, baseball caps.
That'll be the way of funding it. A fantastic conversation. I've just got one question so far from the audience, and if I can share with you, and I think this is going to be a yes, no, maybe answer, but you tell me, guys. On Simon's point, noting the huge amount of liquidity in the market, what should we expect with the government support ending? Will it be a return to normal levels of default risk, or are there now enhanced credit risks yet to come out? And that's a question from Gideon. Thanks, Gideon.
I'll go first.
To answer that?
I'll go first. I think there are significant credit risks to come out. There'll be a lot more default and I can only speak for the UK here with I don't know the European support initiatives so well, but I think the government-backed loans for participants that are in Europe, we've already seen PR in the newspapers in the UK reporting about government starting to write off some of this thing. So I think we'll see significantly enhanced levels of insolvency at the smaller end in particular, but I think that'll push into the mid-market. And then for lenders, that's going to be more of a challenge about a judgment call as to whether those businesses post some of those defaults are supportable or not. Will they lend to them or not? Increased levels of what we call county court judgments in the UK to, as I say, judgment calls for lenders. There are lots of lenders that would not lend to a business in the UK if it had a judgment against it. Will they now have to change their policies and so forth? So yes would be the simple answer to more default coming out of it, I think.
Yeah, I mean, just to echo what Simon said, I can't really comment on the default point, but a lender that focuses on the assets, focuses on tangible assets, is going to be in a good place to support the recovery. So there are going to be some inherent challenges given the volume, that the numbers of businesses out there who have government-backed facilities, and quite rightly, the banks that provided those facilities, they don't want to do anything that might jeopardize the government guarantee. So I guess we need clarity from the government about what happens when there's a significant government loan in there. What can you assign away to an alternative finance provider through a deed of priority or a book debt waiver. So we need greater clarity around that. But yeah, I mean, if you're a funder that focuses on the assets, then hopefully you're going to be well placed to support the recovery.
I suppose just being mindful of fraud, making sure that those assets are actually genuine and collectible. Just to add to the point, I think SMEs since 2019, the Bank of England figure that they've increased their indebtedness by 25%. I think just saying it's a positive to a degree is that the fact is that we have got, you know, a large number of first-time borrowers out there. And I'm just wondering, you know, certainly the British Business Bank always had a statistic about the number of non-borrowers out there in the market. So SMEs that would rather not borrow, not grow, rather than actually borrow some money and grow. And I just wonder whether this maybe as a sort of a benefit that we've shaken the tree a little bit and got some of those SME entrepreneurial businesses to think that actually borrowing money is okay. You know, we can borrow money to get liquidity for growth in our businesses to take things forward. So there you go. That's the optimist opinion.
And that's taking the assumption that you've got the government-backed loans, right? Because then at least you've got the loan. You may need to repay it. I think the other issue, at least for the Netherlands, for instance, is deferred taxes. So companies in the Netherlands were allowed to defer their taxes, which means that you've got this huge debt burden lying on SMEs again. But they weren't financed before. And the question is, with this debt that now needs to be repaid, will they have access to any form of loans afterwards? So yes, I think too, there will be more defaults. And we need to be mindful of the fact that not only do they need to repay either deferred taxes or the government-backed loans, but many of these SMEs are also going to be impacted by the need to change their operating model. I mean, they came into the COVID pandemic doing one thing, and with all the supply chain risk just stemming from the physical supply chain and the way that people now want to do business, or their troubles getting goods out of Asia to Europe, they're going to have to invest in all of these new initiatives to get up on top of the let's say the post-pandemic revival, and they'll need cash for that. And the question is, will anyone be available to provide that for them?
That's an excellent point. I mean, in the UK, we've got I think it's about 30 billion of deferred VAT, and then that's on top of 70 billion that's out under the government lending schemes. So that's a pretty significant overhang. And you know, invoice finance, ABL, they're going to be pretty helpful products in terms of unlocking working capital and managing that indebtedness going forward. So
it's not your debtor.
I always see the government debt, though, surely at least it's the government, and we like to think the government would at least be somewhat benign when it came to supporting the SMEs.
Well, you could be very popular when you're pushing the money out, can't you? But when you're trying to get it back in.
Yeah, and we have the same issue, as you say, Matt, in the UK on HMRC revenue deferred things, and it is I'm not quite sure anybody knows exactly how much is owed in a normal trading cycle. So that will be a really interesting one. But if you're prepared to go with it and support somebody who's got big deferred revenue bills, then maybe it's a good opportunity. I don't know.
Well, that's a big hanging question for us, I think. I think we need to bring our discussion to an end now, because we're coming to the end of our hour. It's whizzed by as ever they do. So I'd just like to say thank you very much indeed to all of our presenters, our panelists today, for bringing their expert views to these discussions. We will be trying to address these questions as the year goes by in more detail through our briefings, our WOA briefings, and we look forward to being able to maybe bring some better answers as time goes by, to as things become clearer. But I'm sure, you know, what we can be absolutely sure of is that the answers won't necessarily be the ones we were expecting. So I think that's yet to be discovered. So just again, thank you, panel, Kevin, Simon, Stephen, and Matthew. Really great session. Really appreciate you being with us today, and thank you on behalf of our audience. And I think Eric is just coming back to say a few words. So I'll say goodbye and thank you all.
Just to say thank you as well to you, John, and to the audience, and of course the panelists. And it was a great session, and looking forward to the next and the coming ones this year. And have a good day, good month, and a very good year. Thank you. Bye-bye.
Be well, everyone. Bye.
Thanks, everyone.
So recording has